Welcome back, everybody. Earnings season is still going strong, and today we're talking about three stocks in particular. One that's been one of my better performers in my portfolio in Caterpillar, and two that I've sold in 2024 and are no longer part of my portfolio in UnitedHealth Group and Hershey. So in this video, we're going to go through their most recent earnings reports compared to the expectations they gave us in the previous quarter and talk about what it means for their future outlook. So let's go ahead and get started. Now, first up is CAT, and it's been one of my better performing stocks, up over 35% since I added it last November. And here's what I said I was looking for from them in their earnings call. All right, next up is Caterpillar, and I really want to see if their margins are continuing to improve and if their full year revenue guidance is still intact. Plus, how high they'll be raising their dividend, since this is usually the quarter when they announce that. So let's take a look first at what they told us to expect in their previous guidance from last quarter. So they basically said they expected Q2 sales to actually be lower than the previous year, and they expect adjusted operating profit to be pretty close to what it was in Q2 of 2023. And then if we go back to what they said for their full year guidance last quarter, they still anticipated that full year sales and revenues to be broadly similar to their record full year 2023 level. Okay, so let's take a look at what they actually reported. So Caterpillar reported non-GAAP earnings per share of $5.99, which beat by 45 cents, and revenue of $16.69 billion, which beat by 20 million, which is basically in line. So they beat on earnings and they beat on revenue, or they were basically in line on revenue. And if we take a look at their earnings report, so it looks like what they told us to expect in terms of sales and revenue came true, where it was slightly below, and their operating profit margin was about the same, if not slightly below what it was last year, which is in line with what they told us. Adjusted profit per share was up as well. And if we take a look at the dividend that they declared in June, they raised it 8.5% to $1.41 per quarter, and that's an increase from the prior dividend of $1.30 per quarter. And in terms of the market reaction, Caterpillar is up about 6.7% since they announced earnings last week, compared to the S&P 500, which is up just a little over 3%. Now, if we take a look at what their guidance is for next quarter, we see they expect sales and revenues again to be slightly lower compared to 2023. And if we take a look at their guidance for the year, actually Caterpillar does this where they do like, here's what they expect in the second half. I usually ignore all this because it's a little confusing. I concentrate on what's next for the next quarter, and then what do they expect for the full year, and then compare that to what they've already guided for the year, because at least that stays consistent. I feel like the stuff where it's here's the first half and second half, it just muddies the water a little bit, and I just stick to quarter by quarter or full year guidance. So now for the full year 2024, they anticipate 2024 full year sales and revenues to be slightly lower than 2023, with the year-over-year decline in the second half being roughly similar to the first half. Now, this is a big change, at least in my opinion, because for the whole year and back to, I think, Q4 2023, Caterpillar's been guiding to have about the same amount of revenues and sales as they did in 2023, which was a banner year. But now if we take a look at their updated guidance, they just had a quarter where revenues and sales came in below what it was last year. And now they're basically saying that that's going to continue on for the rest of the year. And now their full year sales and revenues are going to be lower than they were in 2023. So that was a very long way for me to say that they're guiding down their forecast, because the sales and revenue isn't what they expected, at least at the beginning of the year. And so let's take a look at their sales and revenues real quick, just so that we can kind of see what's going on. And I put this on the quarterly because I think it's a little bit easier to see. But what you can tell is that here we are in the most recent quarter. And if we go back to a year, we can see that it was declined from 2023, right? But if we take a look at the previous quarter, it actually happened last quarter as well. So in March 2024, you can see that it's lower than the March 2023 number. And what's interesting about that is if you go back to the previous quarters, they were all kind of rising for a while. And these last two quarters are the first two quarters in a while where it's been declining revenue growth. Because as you can see all the way back to December 2021, if you compare it to December 2022, it's growing. March 2023, growing. June 2023, growing. September 2023, growing. So you get the picture. Like they've been on a good growth trajectory in terms of sales and revenue, except for the last 2 quarters, which kind of begs the question of, okay, well, is this a reversal trend for Caterpillar? On the annual basis, what you see is that, again, ever since 2020, which was obviously the pandemic year, they've been on a very good growth trajectory pretty much every year. Now, the trailing 12 months is lower than it was in 2023. And why that's important is because remember the guidance that they gave us is that they expect revenues in general to be lower for the year. And so even though normally you would say, well, it's trailing 12 months, it doesn't really, tell the story for the whole year. In this case, the expectation is that 2024 is going to come in lower than 2023. And so not only are the most recent 2 quarters the first downtrends in a while, 2024 is likely to be the first downtrend on an annual basis for a while for Caterpillar since basically 2020, which was the pandemic year. Or if you don't want to count that, you could say 2019, where it was slightly lower than 2018. And then just one more thing to look at. If we look at the cash flow statement and we look at it again on the quarterly basis, and if we come down and look at free cash flow per share, what we notice is that June of 2024 was the first time in a long time that it was actually negative from the year before. Because you can see June 2023 was at $4.96 a share, and June 2024 is $4.72 a share. But if you go through each of the previous quarters here on Seeking Alpha, you can see that it was actually up year over year every single quarter until this most recent quarter. So again, you have revenue that's showing negative growth for the first time in a while, and now you have free cash flow per share, which is also showing negative growth for the first time in a while. Now again, does missing 1 quarter mean that everything's bad for Caterpillar? No, of course not. But here's how I'm looking at the situation overall. We know Caterpillar is a cyclical stock, and a cyclical stock is going to ebb and flow with the economic cycles. And Cat's been on a really good run since about 2016 or so. The revenue growth is not only slowing down, but starting to go negative. The free cash flow per share had negative growth for the first time in a while. And if you remember, here's what I said I was monitoring for Caterpillar a while back. Now, in terms of what I monitor for Caterpillar, is their revenue growth story intact? Are their margins continuing to improve? And is that cash flow growth story still strong? And then lastly, is their dividend growth continuing to outpace inflation? And so if we just go down this list, their revenue growth story intact, well, it's been negative the last 2 quarters and planned to be negative for the full year. Their margins have continued to be a strength, so that's good. Their cash flow growth per share just went negative for the first time in a while, and their dividend was 8.5%, so that one's good. And so for me, I have a decision to make. I'm up around 35 to 40% on this position from just November of 2023. Their growth story is slowing in terms of revenue and free cash flow. Their price to cash flow is somewhat elevated, but their price to sales is at a historically high rate with the exception of 2021. And again, it's a cyclical stock that's been on a good run for years. And to boot, there's a little bit more than normal uncertainty with the US election coming up, although it's hard to predict how much impact that'll have on Caterpillar. So honestly, this looks like a good place for me to probably take my win on Cat, sell, and put that cash away for another attractive opportunity. And I know that some people will hear that and say, oh, you're trading too much, or you're not long-term investing, and that's not what investors do. And quite frankly, I think that's kind of ridiculous. Like, not every company is going to be a forever hold or a long-term hold. And I even think the term forever hold is probably a little dangerous because we should always be looking at what's going on with our companies. But for me, not every company is going to be that one that I hold for years and through hard times. Like McDonald's is a great example to where I am holding that one, even though they had a pretty terrible quarter, because I believe in the company and I want to have it in my portfolio. Or like even Visa, they haven't performed really well at all since I've purchased them, and I have no plans of getting rid of them. But with Caterpillar, even though I think they're a great company, I do understand that they're a cyclical company and that when that starts to go the other way, it's probably not going to be pretty. And Peter Lynch talks about cyclical stocks in What Up on Wall Street, which is a book that I talk about constantly and I praise all the time. And in there he says, cyclicals are the most misunderstood of all the types of stocks. It is here that the unwary stock picker is most easily parted from his money and in stocks that he considers safe, because the major cyclicals are large and well-known companies. They are naturally lumped together with the trusty stalwarts. Timing is everything in cyclicals, and you have to be able to detect the early signs that business is falling off or picking up. And the reality for me is that I think CAT is a really good business, but when I look at their fundamentals, I'm getting the impression that it might be the beginning of a downturn for them. Now, maybe I'm right about that, and maybe I'm wrong. But if you told me back in November when I bought CAT that I'd be up 35 to 40% even after 2 years later, I would have been pretty good with that. But I'm already there at about 9 months. So why risk giving some of that back if the fundamentals are looking like they might be slowing up a bit? This was a win, so I'm taking the win. Plus, I think there might be some really interesting opportunities out there that are a little less cyclical in nature or have a little bit more runway. And that being said, I wouldn't be surprised if I looked at CAT again in the future once that cycle starts to bottom out again, but we'll just have to see. And at the end of the day, this is what makes investing interesting. We can have ideas, put our money to work, and see how they pan out. And sometimes they work and sometimes they don't. And in this case, CAT was really a home run. So I'm super excited about it. Now, just to be clear, if you own Caterpillar, you bought Caterpillar, or one of my videos is one of the reasons why you're into it, you don't have to sell. It's all about what your goals are. Caterpillar is one of those companies that they're well ran. People who hold it over the long term are probably going to do well. But I've decided to be a little bit more actively managing my portfolio to kind of meet my own personal goals. They don't have to be the same as your goals. And so don't do something just because I'm doing something. Obviously, if it fits what you're trying to do and you like the company, then by all means, keep it. Okay. Let's talk about UnitedHealth. Now, I sold UNH earlier in the year, mainly because I'm just not very confident in any U.S. healthcare company over the long term, even though I think UnitedHealth is probably the best of the bunch. And here's what I said earlier in the year. Now, in terms of UnitedHealth, I wrote a very long explanation of my thoughts on UNH in my newsletter a couple weeks back. But basically, the bottom line is this. I think UNH is the best managed healthcare stock there is out there, but I don't want to be invested in the U.S. healthcare system because I have a lot of concerns with it. It's an extremely complex yet low-margin business. It's highly political and almost universally hated by consumers or users. Their costs are rising and their ability to keep raising premiums is going to be heavily scrutinized. And just in general, the health of Americans is slowly deteriorating over time, which I think is going to put pressure on the frequency and costs of medical care going forward. And then lastly, it's just not a business that I feel like I understand very well. But UnitedHealth is one of those where, again, if you're holding UNH and you like the company, then keep it. Almost every analyst has it rated as a buy, and it'll probably do great just like it has over the past 10, 20, or 30 years. But for me, I didn't have the confidence in it, so I chose to put that money into other stocks that I have more conviction in. And just FYI, since I sold UNH, it's up over 14% to the S&P 500's 7%. And if we look at their latest earnings in July, it said UnitedHealth beats bottom line estimates and updates their full year outlook. And that's because they basically beat on earnings per share and were in line with revenue. And if we take a look at the details a little bit closer, they had revenues of $98.9 billion. They had adjusted earnings of $6.80 per share. And probably most importantly, the company affirmed the adjusted net earnings outlook of $27.50 to $28 per share, established at its November 2023 investor conference. The consistent outlook absorbs an estimated 60 to 70 cents per share of business disruption impacts for the affected Change Healthcare services, which has increased 30 cents per share since the initial estimate was provided last quarter. And basically what that means is that they're getting increased impacts from their cybersecurity breach issues, but they're still able to absorb that and meet their original guidance for the year, which in general is a positive thing. But one of the things that I was watching when I held this stock was their care ratio, which is basically the ratio of benefits that they've paid out versus the claims that they take in. And this number has been steadily rising for a while, and it was one of my big concerns with the company. Now, in the most recent quarter, it was 85.1%, and they have a lot of different reasons why in terms of the one-time impacts that they're dealing with. But overall, this has been a trend for UnitedHealth that is more than just this past quarter. If you look back over the past few quarters, you can see that it went from 82.2% in Q1 of 2023 to now 85% in Q2 of 2024. And while there's been a little bit of fluctuation, in general, the trend is up. And why this is important is that policy premiums is the largest part of their revenue. And what we see is that their expense growth has actually outpaced their revenue growth over the past year or so. because both in 2023 as well as trailing 12 months, their revenue growth is actually slower than their expense growth. But the question is that something that's going to continue? Or is it something that's just a fluctuation in the data, maybe in the business for a year or two? And the real answer is we don't know. But what I think is that with the deterioration of the health of Americans combined with political pressures to bring down the cost of healthcare, I'm not sure how exactly that's going to improve. But you know what? Even with all that, UNH is up 14% since I sold. So even though it's something that I think is important and might be a worrying trend, other people either don't agree or don't know yet or don't really have a strong opinion either way. And that's what makes investing interesting, because we can all have different opinions, look at different things, and come up with a different answer as to if a company looks attractive or not. And part of what makes that tough is that we look at something that we think is important, but the market may not agree for years or ever. And let me show you another example of what I mean, because Hershey's another stock that I sold earlier in the year, and here's what I said at the time. And this is a critical point. Hershey was never going to be some high growth company. What attracted me to them was their consistent growth and increasing cash flow that they turned into double-digit dividend growth. So when you combine that with a 30% sell-off in 2023 and what I thought would be an easy year for Hershey to beat low expectations in 2024, they seem like an attractive opportunity, even if their overall growth prospects were slowing. Because by their own admission in their investor day last year, they only expect 2 to 4% revenue growth long term with 6 to 8% earnings per share growth. So while they've been a double-digit revenue grower in the past, they definitely don't expect that for the company in the future. Still, I thought that they would stay closer to their original 7 to 8% earnings per share growth guidance for 2024, and they definitely didn't do that. And I sold Hershey in February mainly because their outlook for the year drastically changed in one quarter. They went from a 7 to 8% earnings per share guidance to a 0% guidance with slowing sales, rising commodity costs with cocoa prices going crazy, and their salty snacks not performing the way that they expected. And if we take a look at what Hershey just reported, they had a double miss on revenue and earnings both. And if we take a look at the actual details, it's worse than it looks. They had sales down 16.7%, and they have caveats as to why in terms of planned inventory reductions and all that, but still, that's a pretty jarring number. They had net income with a decrease of 55.1%, and then adjusted earnings per share down 36%. And not only that, they downgraded their forecast from 0 earnings per share growth to down slightly or down 1 to 3% on a non-adjusted basis. Now, they do expect stronger performance in the second half of the year than the first half, but no matter how you look at it, that's a pretty terrible quarter. And especially for a company that's still trading at over 20 PE and over 18 price to cash flow. But even then, Hershey is up 2% after earnings compared to the S&P 500 being down a little over 3%. So again, this is a great example of how market reaction isn't always correlated to business results, at least in the short to medium term. Now, personally, I believe that they are correlated over the longer term, but we'll just have to see. But one thing you might have noticed is that with me now selling Caterpillar, it means that I've sold 3 of my top 4 picks for 2024, and I mentioned that I had some thoughts on what I learned from that experiment, so more on that in a future video. Now, if you want to see my original analysis on Caterpillar for when I added it to my portfolio, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.